Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, July 8th, 2026. It's 1:08 p.m. Eastern Time, so I'm starting the video, and this one's going to be an eclectic mix of just some of the things I'm watching today. Certainly not an all-inclusive. And what I'm going to do, I'm going to do my best not to get too granular on any one thing. If you want to reference or some of the recent analysis, deeper analysis on things like gold, silver, GDX, the stock market. I'm going to go over quite a bit. I'll tell you what I'm going to go through here in a second. But what you can do is go to the bottom of the post, click on the ticker tag under each post on right side of the chart. On the very bottom, it says tagged, and all those tags are hyperlinked. So GLD or $gold, those are both gold. GDX will take you to any previous analysis, all in chronological order. So you can go get a deeper dive there. The reason I'm just gonna kind of do a cursory overview. I want to get through several different, really unrelated stuff, just some of the things that stand out today, not all inclusive. So here's how we're going to do it. We're going to look at the precious metals. That's gold, silver, of course, GDX, the miners. And as I often say, any analysis in gold, silver, and GDX is incomplete, in my opinion, without looking at the dollar, being that the gold and the metals move inversely. They tend to move inversely to the US dollar. I'll talk on bonds. We have the Japanese bonds making new highs, the 40-year, I think even their 10 and 20 years just making new all-time highs. I'm going to talk on that related note. Treasuries, UK gilts, pretty much the big countries, the big G7, the countries that matter the most, the world's biggest economies. This is truly bizarre world. I think if you had told any economist, 3, 4, 5, 10, 20, 30 years ago, if we had yields breaking out to new multi-decade or even all-time highs, and the stock market being right around all-time highs as well at the same time, they would think you're crazy. So it is a truly bizarre world right now, but we'll get to those. Quick update on XLY. I want to go over a few components there. That's a consumer discretionary sector ETF. Just going to look at a few things and a couple individual stocks. And then finally, I'm doing this in reverse order. We'll wrap it up with the stock market. QQQ, give you some sell signals today. We're still flirting in those ranges. Remember, bigger picture, we remain in about a 2-month sideways trading range. So I'm trying to get very granular with some micro levels. I'm also trying to do that on on the backside of a holiday week. Again, 4th of July, trading volumes plummet. The week before, the week after, half the world's on vacation, or half the U.S. at least, and even around the country. Kids are out of school. It's when people take vacations. So, and then time permitting at the end, quick updates on the semis and the financials, including the regional banks. So a lot of stuff. Let's dive right into it. All right, GLD, this is gold. To recap, somebody asked me about today. They mentioned a breakdown in GDX. Not to get too hung up on the vernacular, the terms. I don't see a breakdown in GDX. I'll get to that one second. But gold, if you recall, had a blow off top. Talked about it. We nailed it right there. We shorted silver, gold in the initial crash. I gave you at the time 1, 2, 3, a total of 3 price targets with a potential 4th target that is still just that. It was never made an official target. So just recently we hit my 3rd target zone. We hit the top of it here and the bottom of it there. And I am going to reiterate, I still like gold. I'll get to what I've told you recently, for a bounce trade. I also called for, before we even peaked, that we would most likely, after a blow off top, that tends to be the end of a bull market and the beginning of a new bear market with about 3 components. And those 3 components were the initial crash, several months of sideways action, then followed by a resumption of a bear market that usually spans a year or more. So I am only near to intermediate term bullish, looking for a counter trend bounce. Longer term bearish, but again, I'm not going to ever position for where I think gold's going to be a year from now. I will always be positioned where I think it's going to be today, tomorrow, next week, next few weeks, as a active swing trader, trend trader. Anytime I'm in even a trend or longer term position, even in what some might call an investment, if I have a holding period of a year or more, if I suspect a 20 double digit plus counter trend move against my position and I can make a strong case for it, yeah, I'm going to get out and either profit from it in the other direction or sidestep it and then get back in after that counter trend move. So, but to reiterate, again, we are still back right on. Remember, the third target zone is a support zone. So if I like gold here and we got a bounce out of it and I liked it here, last update in the video, I still like it here. Nothing's changed. This isn't a breakdown. A breakdown is if we take out, remember, you have a primary, very, very well-defined uptrend line and very, very nice, in my opinion, price support. A major reaction low back there. And if I thought it was a support zone when I gave it to you all the way back on December 29th, as we were going up, started giving you targets, and then that's where the entry point was. I've been further validated. My analysis has been validated by all these reactions there. Okay, I'm not trying to speak cocky or confident. It's just, it's in a level that I figured would be a significant technical level. That's why I made it my final target zone based on that and many other factors. You know, it's one thing to identify support and resistance levels. It's another to try to figure out where the end of a trend is going to stop and reverse. And again, at least for now. So that's it. Hard stop. And if we lose that, yeah, it's not going to be bullish. I wouldn't add. You might give it a little bit of room if we punch down through there. We still have positive divergences on gold. This is the daily chart. You still have them on the 60-minute chart. We're coming off a divergent low right here. And then let's not forget on the weekly chart, you can see it pretty clear. I know this is a bit busy, but here's your primary uptrend line off the October or late September, maybe 2023. It's the same uptrend line I gave you on the daily chart. Just very, very well defined. Lots of reactions. And so that's where we're at. We're oversold. I don't know why. There it is. We're getting oversold on the weekly chart. We're not all the way down there yet. PPO is the signal line, is back testing the zero line from above. And listen, guys, I'm not married to the multi-year bear market scenario in gold, silver. Again, like I said, that's what history has showed when they've gone parabolic. Again, you can reference the previous videos. You'll want to go back to January or so, right before the top in gold, silver, and look at the videos that preceded that. And that talks about it. But typically, you know, this is a trend on the weekly chart, a longer term trend delineator, as I've covered recently with a lot of stocks. And so pullbacks to the zero line often contain corrections. And, you know, when you're in a bear market, you spend more time below the zero line, the PPO does, that is. And that's it. So, you know, gold's been mostly, you know, well, again, we're spanning decades here. All right, so that's it, guys. Let's not overthink it. Gold had support. That's it. So if you liked it back here, you liked it here, what's changed? And to me, nothing. Silver, so when gold hit its final target, remember, gold's the main one you want to track. Silver will always follow, ultimately, not day to day. Sometimes they separate trends for a few weeks, couple of months even, and those are great mean reversion trades. I love it when gold's rallying and silver doesn't get the memo, it keeps falling. We've had quite a few of those over the year, or vice versa. Gold starts correcting, silver's going up. Silver got ahead of gold here and it crashed more. And you get those mean reversion trades because, again, it's always going to follow its big brother, gold. And so we hit my third and final target, overshot a little bit, but that's really, you know, there's nice support. And again, this is a buy zone for silver or the silver mining stocks. And let me get the GDX because that's really where the last trade of focus. So GDX, there was your, well, that was our initial sell signal right there when gold and silver crashed and peaked right there. GDX made a marginal new high, the miners, and I gave you a total of 3 targets, but I canceled T3 because gold hit my final target. To me, it would be just ridiculous to maintain a short position on GDX if you thought gold had stopped falling and was going to bounce or have a meaningful, you know, counter trend rally. So that's why I canceled that. So we hit it there, we hit it again. I gave you a couple bounce targets. This one here, 8110, which was the former first target. I can't remember, was it the trend line or no, it was price. It was that price support. We hit that, we pulled back down, and we're right back to that T2 support level. Somebody asked today for an update on this. So again, this isn't a breakdown. A breakdown is when you break support. So right now, the same in the last video I gave you here, um, uh, gave you highlighted the positive, aka bullish divergence. Same exact reasons in reverse. We had divergent, negative divergences building, shot across the bow. That's when gold and silver peaked. Miners decided to make a new high because there was a feeding frenzy among the retail crowd. They just wanted in, there was massive FOMO, and they managed to run the miners up a little. Plus, as I told you at the time, with oil prices going through the moon, that's put pressure on the miners, and that certainly played into them dropping as well. But other than today, I know there's it's almost a joke now, the whole taco thing and Trump chickening out, and Trump saying one thing, oh, we have a good agreement, solid, and Iran saying a completely other thing. And so I think at this point the president's lost a lot of credibility, with whatever he says about the negotiations over there, because Iran is doing what they want to do, um, and so anyway, so as we know that things are not, as I said, they're not holding hands and singing kumbaya, not quite yet. So, but again, that's just a volatile trade. Up today, crude up today, down tomorrow. The bottom line, we're still off that 110 barrel. Crude's still way off the highs. It's right now. I'm looking at another monitor where it's 74.19 on CL crude futures, so $74 a barrel. So relatively cheap. And again, that my whole point on that, as I've said, that is a net tailwind, net bullish for the miners, because it lowers, ultimately it brings down their second largest input cost, fixed cost, which is energy, be it diesel fuel for their machinery, heavy machinery, electricity for the sorting facilities and all that. So when energy costs go down, doesn't guarantee that the miners must go up or will go up. It just says that it helps their profitability versus very high oil and energy prices. Okay, so no change. We're right back to T2, guys. That's support is support until less broken. And if you reference the last video, last time we were right here, I gave you a buy zone. I said that we could continue to drift lower. Here, let me show you. This is the chart I posted. You can catch it in the comments section in recent videos. When we got down here, more of a buy zone, a scale in zone, not a hard entry, based on just the technical posture. The gold's still not a screaming buy, more of a scale in down to. So the plan was and remains, scale in down to, but not below 67. And you'd have your stops, again, depending on your entry and your price target. I think we'll have another run back up to this downtrend line and that 80-10 level again. And that all will depend on many variables, of course, but including but not limited to what the dollar does. There's just a lot of movement right now with currencies. The yen, I think, just heard made a new all-time low. I'll get to bonds in a second. And this is the dollar index. So we had a breakout here. That gave us this pullback gold. Then we hit my first target. Remember, I've been highlighting this basing pattern here. The dollar broke out, hit my first price target, as expected, pulled back, and that was the catalyst, at least a fundamental catalyst, I should say, for that. Let me just go back here. That was on June 24th, the GDX, gold, all that stuff rallied right here. There's June 24th right there. There was a June 24th video, and that's where I showed you that, and that's it. So we bounced up. That was that first resistance level, 81.10. And so that coincided perfectly with the drop in the dollar. And what happened then? The dollar has risen since then, and therefore gold and the miners have pulled back, right? Simple stuff. So you don't always get that lockstep correlation, but lately that's been trading. So there's a dollar rising after it hit T1, that first target, pulled back. This was a support zone here. That was the breakout. It was just a successful back test, and so the bounce in the dollar. Now, you can see from this wedge here, as I've talked about, We have a bearish rising wedge. We could work our way higher in it, or we could break down. Either way, we have negative divergence. If we break down soon, especially a fall back into that trading range, that would be bearish for the dollar. Dollar would fall, and that would be a net headwind. I'm sorry, a net tailwind, meaning net bullish for gold. Okay, please understand that term. When I say something is net bullish for something, it doesn't guarantee that that thing that it's net bullish for must go up. It just simple as term implies a net bullish, and that's simply because a falling dollar takes more dollars to buy an ounce of gold. If you freeze supply and demand, that's why the price of gold will go up. Just like a rising dollar, if you freeze supply and demand on gold, will cause the price of gold to fall. Okay, let's rifle through just real quickly so I can get on to the next stuff. Some of the top components here. You can see I have them sorted by market cap, with Newmont being the 800-pound gorilla sector, 800-pound gorilla in the room. Divergent low at trendline support. Again, this is just, I'm sorry to use the term if I use it too much, just a beautiful uptrend line. I look at charts, and to me it's like a art enthusiast going into the Louvre, and looking at, paintings from some of the greats. This is just a nice clean up trend line. Does it guarantee we must hold that trend line support? No, but we have positive, aka bullish divergence at support. So I'm going to say it again. I like the miners here. I am long the miners. I will give them a little bit of room if we want to have a little washout, flush out move, but not much. And it's not an all-in moment because, again, I called for what's likely a top in a bear market. So what happens is sometimes if we do have a bear market with more to go, divergences and bullish setups and support levels like this are just speed bumps on the way down to lower lows, right? So, but again, I'm not married on that, longer term, bear market thing that a year from now gold's going to be even lower. All I can tell you is today. I can tell you today with certainty, I see gold in a lot of these miners, in the metals and the miners at nice support levels with positive, aka bullish divergence coming off oversold levels. That's my kind of setup, guys. So I just want to reiterate, these are the days I like to get these things out to you. You know me. I'm not the guy to come out and tell you when the miners are up 5-10%. Oh, we should have bought the miners, or you should buy them now. No, usually if there's a big rally, if it's into resistance, I'll say they either wait for a pullback or sell them. So I like to come out on days and get bullish on stuff when everyone else is bearish, and vice versa. Not just for the sake of being contrary, but again, the investing, swing trading, it's all about, buy low, sell high, that kind of thing. So that's it, guys. We're at support, and I'm going to go over just a handful of them. And so when you can do that, when you can look at the majority of stocks, there's positive divergence. That's not good, but if we can whip back up there, so I'm going to recognize and call a spade a spade. This was a support level had on AEM. It was a pretty well-defined support level. We danced on it there, and it took it out. So that calls that into question. But if the rest of the miners, and especially if gold and silver reverse AM, this will prove to be a whipsaw, a false breakdown. I've repeatedly said that the weeks surrounding Independence Day holiday are plagued with whipsaws from my experience, so it wouldn't surprise me. Now, in this particular one, let's just say you're trading AM. Do you buy it on the breakdown? No. There's only one trade to be made when a stock breaks support, and that is to short it or to get out of your long. But if you like it, watch it. If it recovers, that's your buy signal, because then it means this thing was a failed breakout. So the shorts that jumped in today and the weak-handed longs that got cleared out on their stops, it gives you a stronger, the shorts have to cover because they realize the reason they shorted is no longer valid. They shorted a break of the 150.50 support. And then you get just a stronger hands. If the longs that didn't get stopped out on that move, they're iron fist. You think they're going to sell if it comes back up? If they didn't get shaken out today, then they certainly. So that's why I say you get a kind of a new set, a stronger set of hands on false breakdowns like that, with clearing out, like, again, I call them the weak-handed longs. And then you get a double whammy with the short sellers having to cover. But that hasn't happened yet. But again, that would be your buy point. And again, I would recommend or suggest you do what I'm doing. Don't just trade AM in a vacuum. What's gold doing that day? God forbid gold breaks support, silver breaks support. Yeah, AM is probably going to go lower. So look at them all collectively. WPM still coming up, nice positive divergence. I pointed out that divergent low. You got a nice, these are nice counter turn rallies. That was 22%. And we're coming up on support now. We still have the same positive divergence that we had in place. And I highlight it back here. That's when a lot of gold first hit our top of our target zone. I expected a bounce, called for it in the metals and miners, and we got it. And the only thing that's changed is the divergence has grown even larger now as we come up to this 103-ish support. So if I liked it then, what's not to like it now? Or what's not to like about it now? FNV, there's a little potential stick save. If we can get up here, there's a intraday break. Look at, we're right back about on the support level. Positive divergence. So that's it. Barrick, same thing. A lot of these guys are punching through those resistance levels I covered recently, but so far a nice intraday reversal and they're getting back on. So if they park anywhere close to, on, or especially above the trend lines, this is nothing but bullish. So again, I will reiterate, I like the miners. I like them even more today than I did 2-3 days ago, because now again I'm seeing some of these false breakdowns in play here, and I'm seeing the others that didn't fall all the way to their next support getting a lot closer now as well, like KGC, that 2208 level. Again, these were all covered in recent videos. You could check those out. PAAS is one of my favorites. This one rocks with when silver goes, especially. It says Pan American Silver Corp. Royal Gold. I'm just doing the divergences are just extended. A lot of these guys are still at or near support with positive, aka bullish divergences. And look, remember, a lot of them, you're looking at my charts. I'm showing you trend lines, which have been bounce targets. We already hit them once at the first time gold. Remember, the first time gold hit support, we bounced up, and a lot of the stocks in GDX hit the downtrend lines off the highs. We could easily break out. And again, I'm going to be watching the dollar closely. I'll be watching these guys, and I may add some, additional targets, upside targets, on the metals and miners. So, all right, let me see if there's any more. I'm just rifle through these. We're going to move on. There's a lot I wanted to cover. AGI, I covered that. HL, CDE at support, positive divergence. IAG at support, positive divergence. Again, almost equal lows or more slightly lower lows on those guys. All right. That's enough. You can see them all. I'm just being repetitive now because the story or the common theme is just like a few weeks back. A lot of them reversed a little shy of support. Now they've made full tags of my support levels, and those, some of them didn't have, like this one for example, didn't have positive divergence when gold hit support there and we got that initial bounce. That was a double digit bounce. Now it looks even better. It's at full tag of support with positive divergence after a couple slight undercuts to flush out some weekended long. So okay, all right, we'll move on. Next up. All right, so as I'm not going to pull all these charts up, I told you the Japanese 40-year bond, and I think I heard the 10 and 20. I was scanning headlines, all made new all-time highs since, again, not 52-week highs, not multi-year, all-time highs since these things came out. So you've got and that matters. And then what they say, what's unusual is the yen just made again, if I scan the headlines and remember correctly, a new 40-year or all-time low. Usually you're going to see the yen rallying. This is very unusual, and it's kind of market cracks when a country's rates go up. What makes the dollar or the yen or the euro rise or fall? They don't trade in a vacuum. Their value is based against other currencies, and so that's what they're rising and falling against. And in very simple terms, if one country's central bank is more hawkish and raising rates or has higher rates, or especially increasing rates, while another country is holding steady or lowering rates, that's going to cause the country whose rates are higher, their currency to be stronger and go up, right? Only makes sense. And vice versa. So Here, you can look at USD JPY. Again, this is just the dollar against the yen, so you can see it's punching out here. This isn't just the yen in itself, but this is you know uh, we have big divergences, so you're probably going to get a reversal here soon. What does that mean? The dollar has been very strong against the yen. The yen is, by the way, for those of you not familiar, it's the second largest component in the U.S. dollar weighting index. I'm sorry, a 13.6% weighting. The euro is by far the largest. Everything else doesn't even add up. Doesn't matter what the Swiss francs do, well, the euro, or any, I should say, any of the other non-euro currencies, the global currencies around the world. This is the one that matters. This is the one that moves the markets. EUR USD is the biggest at the euro, I should say. The euro has a 57.6% weighting in the dollar. And what you can see here, so to me, I see positive divergence. So you got the way you have to read this, euro comes first in this equation. So euro versus a dollar. So this is a euro falling. And so if it rallies, if the euro revert, and it's coming up on this, yeah, pretty decent support. So if the euro starts to rally, the dollar starts to fall. And that would be based on this chart, you have the bullish divergence down here, right? And then I showed you a second ago, JPY USD, the second largest at 13.6%. Looks like, even though it's just made, the yen's made a new low, looks like we're going to get a trend reversal. At minimum, we'll pull back here. And so that means the dollar falls as well. So, yeah, that's it. We're making the case for a bearish dollar in the coming weeks to months, correction, and that helps support a long position in the metals and miners, despite the fact everyone's probably given up on them by now. And that's what I like to see. And again, most importantly, I say this a lot, gold, silver, whether you're trading the ETFs, the futures, GDX, or any of the individual miners, they should only be one part of a well diversified portfolio, whether you're an investor or a swing trader. If you want to put all your money in GDX right now, or Nugget or Dust, or whatever you want to leverage it up, or futures, fine, that's your thing. You might as well go to Vegas, put on, Black 16, roll the roulette wheel, let it see if it hits. Me, I'm a big proponent of diversification. So these are only, should be one piece of a bigger pie, meaning your portfolio, whether you're an investor or a swing trader. Um, Spread your bets. All right. Nobody bats 1,000. Okay. So covered bond. Oh, no. Let's get to the US bonds. So I talked about, all right. So back in May, I don't know where we're at now, but the 30-year UK gilt hit its highest level since 1998, broke out to new not multi-year, multi-decade highs, a 28, almost 30-year, almost a 3-decade high. And then we just had the, Japanese bonds breaking out to new highs. And I keep warning, and this is where it's like bizarre world to me. Maybe I see things that just aren't an issue, but we haven't broken out yet. But here's the 30-year yield on the U.S. Treasury bond. We're again, we're coming up pretty good here. We're within what I call spitting distance. This little punch through there. It didn't last long, and I predicted it wouldn't. I told you that Treasury would come in. It would be all hands on deck at the Treasury and or Fed to manipulate, come in, market intervention, and make sure that the 30-year, at least on that initial punch through, was shot down, and they did. I'm a believer that the Fed and Treasury can, in the short term, manipulate and steer, things like the yields on bonds due to, you know, buying, selling, and all that, money printing, whatever they need to do, all kinds of shenanigans, all kinds of tools they have that are even beyond my scope of expertise. However, I am a strong believer that market forces will ultimately prevail. And so I've made the case repeatedly and believe that we ended a nearly half-century secular bear market in interest rates, meaning falling rates that peaked. What that bear market started right here in the 1981. and ended in 2020. And by every technical metric, again, I've covered this in the past, we've started a new bull market. In my opinion, that's not debatable. Whether what's debatable is where we're going to be 5 years from now, even 10, which I think is higher rates. That's debatable. We could sit here all day long, go back and forth, but nobody can argue that we're not haven't been making a series of higher highs, because this was a higher and higher lows. That is an uptrend since this point. We also, by the other technical metric I like to use, we took out the secular bear market downtrend line. I had that one, a little alternative trend line, but both clearly taken out. So again, this is indicative of not just a blip in rates, because I say this because the media just, they talk about, oh, they're just waiting, all these people waiting for the, come back to the 3 2 3, 2.5 3.5% mortgages, 4% mortgages. It's like waiting for Godot. Godot never showed up at the end of the book, so, or play, whatever it was. They're waiting for that, and hey, maybe they get it. If they do, I can tell you, we'll be analyzing this along the way. Um, very near term. All I can tell you right now, let's not even talk near term. Let's just talk today. And right now, as I speak, this is the weekly chart, as I've talked about quite a bit. If we break out to new highs, we take out that recent high, I'm going to drop back down to the daily chart. Remember, we have so far in the last few years here, a triple top. We keep hitting this 5.15% yield on the 30 year, and we've gotten down, but you can see the lows are getting higher. If we break out, and I think ultimately we do, whether it happens next week, next month, or within the next year, is what I think will break out. And that's going to be just a knife through the bull market. That's my strong opinion. Now, the thing is, do I load my portfolio on puts because I think it's going to happen, and just throw away the key? No. If it happens, we'll react at the time. All I can tell you is right now, again, we're within spitting distance. By that, what I mean by that, as you can see, from today's high in the yield, we're only about another 1.42%. We've gone up twice that in the last week or so, what we need to break out the new highs. So the risk, in other words, we may not break out, or we may not break out soon, but the risk right now is to an upside break more so than a downside break of the trading range. When I circle that, this is the kind of the trading range treasuries have been in lately, and more so is this more recent trading range right here. So there's zero risk of us breaking to the downside, which would be bullish for the stock market, falling rates. So again, it's a risk that I don't think, no, I am certain is not being priced into equities with the stock market near all-time highs. The simple fact that that's also not debatable when you talk to anyone with a financial background or economics. Rising interest rates are bearish. We know, and it surprised me and some others. And the lock-in period. They talk about the debt wall, and I was back here. I was reading up on some sources that were citing the traditional, and I covered it on the site too, going back a few months. I talked about the average maturity. Small caps tend to be a little further out, usually 5 to 8, maybe 6 to 8 years is on when they take out debt, and then large caps a little shorter, 4 or 5. And so a lot of that debt should have been coming due. But then again, shame on me for not verifying this source. I had read up on that. Saw a few analysts talking about it, that the debt wall should have been hitting here. In other words, all this cheap debt that was taken out around that time should have been maturing. But then I read, no, they did what a lot of individual investors did by refinancing the mortgage. They extended out both the majority of corporations that were able to, and every corporation out there, if there's not a single corporation out there that didn't take advantage to refinance existing debt or to borrow, even if they didn't need it, to take that free money for future use, they should be, quartered and drawn, tarred and feathered, or, certainly have lost their job. My point is, guys, they all did it. It was a no-brainer. And what they did is they did extend out. And so the debt wall, according to what I've done, now you have these AI tools that just, what's good about them, they're just another iteration of search, Perplexity and Gemini and Grok and ChatGPT, but they're just more efficient at parsing the data you need and getting to it. The old Google used to be about, click, you get some results, but a lot of times they were, you know, their model worked to, for shopping. So click on something, you go to a website and buy something, get paid. So, that's where I find the usefulness of these tools, because you can do, and they'll cite sources, especially with Perplexity. That's one of my favorites, but I'll use them all. And I use them all also to make sure, one's not hallucinating. So if they all are telling me the same thing, and that's what they're telling me. So the debt wall, when a lot of the bonds that were issued and money borrowed by corporations, large and small, is coming up on us. It's supposed to start hitting the second half of 2026 and really come in full force next year. The market's always been a forward-looking mechanism. So right now, what I see is I see the stock market and investors, really, institutional and individuals, playing a game of Russian roulette. In my opinion, there's not one, but probably two or three bullets in the chamber, betting on the fact that, somehow rates are going to come down. The Fed's going to cut rates, inflation's going to go away, clearing the path for the Fed to cut rates. And then, even in doing so, and they're also ignoring what I've covered again repeatedly over and over on this site, that the Fed has lost control of the yield curve. I repeat, and I've been repeating, the Fed has lost control of the long end of the curve. I mean, remember, the Fed, they set the federal funds rate. That is an overnight lending rate that banks can borrow from each other. They can go to the discount window directly to the Fed, or Fed funds rate, borrow from each other, overnight lending rates. These are short, super short term. You, I, even your connected neighbor that works for Goldman Sachs can't borrow. You can't go and borrow at the federal funds rate. A firm can, banks can. So it does nothing for Joe consumer. Now, historically, it has, because when they lower that rate, it's cheaper lending. The banks rates that banks are doing these overnight transactions to keep their liquidity reserves, match. Then they can then lower interest rates on loans, car loans, mortgages, everything else. In other words, it trickled down to longer term rates. But the opposite started happening back here, because for the first time in nearly half a century, inflation finally started to rear its ugly head. So the Fed cut rates. I marked it here, and they started with a whopping 50 base, very unusual 50 basis point cut back in September of 24. Usually 50 basis point cuts have historically been reserved for times of financial distress, problems in the market, credit markets, financial markets. And what happened, instead of long-term rates dropping, they actually shot up. They didn't just stay put. That would have been one thing. They went up the other way. Fed tried again. Next meeting, another 25 basis point rate cut. Initial spike, little abatement, but still way above the first big cut. And then another surge. And then they cut a third time. This was their WTF moment, or in Scooby Doo, the Ruh-roh moment. So they realize, we need to back off. What we're doing, and the market is now saying, if we keep throwing this easy money out there, which we've been doing since 2008, since the financial crisis, it's going to continue to fan the flames of inflation. So they cowed down. They waited a year. Rates remained elevated, and they started another rate cutting campaign. They started it right here. So almost exactly a year later, a year and a day, one day shy of a year later, September 18th, 24, September 17th, 25. They did, again, 3 consecutive back-to-back cuts, quarter point each. And where did rates end up after that? Here. So this is the pickle we're in, guys. So again, the market is somehow thinking things are going to be different this time. Maybe it will. There's nothing ever written in stone in the financial markets. But we've seen that every time we start to get a little abatement of inflation, it comes back again. And one of the simple metrics I've always used for inflation is DJP, or any of the broad commodity ETFs. You have DBC. They track broad-based commodity indexes. And by every single metric, again, just like treasuries, and something I've called for since the beginning of 2020, the end of a secular bear market in commodities, falling commodity prices that ended with COVID, just when interest rate, the secular bear market and rates ended. And all I see is an initial wave up in a new bull market that I've been calling for and maintaining. That we just made a newer high. That was the first big corrective wave, and so I expect again, we'll try to call these minor blips and squiggles along the way, but as long as we keep making higher highs, like we just made a new higher high, where does it start to come into question? Well, if we take out that previous low, that would be a start. And we go down below this support big, that was a very important support level on DBC. It's just another one of the broad-based commodity tracking ETFs. DBA, oh no, DBA, that's the ag one. That's agriculture. So I use DBC and DJP. And you can see again, they're just broad based. You've got everything in there: gold, crude, natural gas. You have West Texas crude, Brent crude, corn, soybeans, copper, aluminum, so industrial metals. Live cattle. You've got it all kinds of commodities. And so, if you're wondering why I'm talking about commodities, am I going off on a tangent? No, because it is the single best real time indicator of inflation. Housing is certainly, but the Fed's convoluted method of using owner equivalent rent. So the price of your house, if it went up 50% in the last few years, technically it's not factored into the CPI. They use some convoluted thing, owner equivalent rent. What could you get for your house if you were to rent it, instead of just looking at home prices or looking at actual rents? Either way, guys, but this is a real time. And the problem with the housing market too is that there's such a lag time to reset. You're looking at your Z estimate today, and your house might be worth $1 million, but you go to list it and you find the stark reality it might only sell for 800, 850. So values in real estate are reset. It's not a day-to-day thing. It's not accurate. Commodities are, because on any given day, usually 6 days a week around the clock, futures for various commodities including crude oil and metals are trading around the world, around the clock. So you have real time. It's what I call the best, closest thing to a real time inflation indicator. And so that's it. So, good luck with the Fed taking rates back down and getting mortgages back to 2-3%. If all of a sudden this happens for some reason, I don't see it in the charts. I could see a correction, a deeper correction, but I won't start. My longer term outlook really wouldn't come into question until at minimum. I'm not saying it would change there, but at minimum, a break of these recent lows right here from 2023, 2024. Okay, we're almost there. We're just going to cover XLY here real quick. Then we'll get to QQQ. We'll wrap up there. This is a long-term chart. XLY is your consumer discretionary sector. So there's a total of 11 sectors in the S&P 500, discretionary being one of them. That is the other consumer sector is consumer staples, and that's where we've been. I've been selectively bullish, again, very selectively bullish, not broad based, and we've been just nailing them. Again, compared to the market, these aren't massive trades. Every year there's at least a handful of trades on the site that do 100% or 70 to 100% plus returns. Those are explosive trades, but we're hitting these steady. I call them grandma stocks, blue chips. The General Mills of the world and all those the food companies. We had progressive insurance companies recently. So steady Eddie, blue chip dividend paying stocks. And the staples, again, I always say, those are things that you need, and discretionary are things you want. Okay, so in a strong economy, especially when the stock market's near all-time highs and the housing market's strong, consumers feel good. They're paper rich at that point in time. Their wealth has gone up, so they're going to buy discretionary items, things they don't need, but rather they want. They're going to go to Best Buy and get that 90-inch or 100-inch, flat screen TV. Replace the 72-inch that's on the wall, whatever. All right, so we're going to look at this. So this is a secular bull market, started back in '09, like the stock market. There's our trend line right here. We're building some big divergences, and every so often, even in a bull market, you get the divergent highs, you get a drop, 21%, divergent high 1, 18% drop, divergent high 2, 17. Divergent high, that's not measured. I'm sure that's close to double digit, if not a full double digit. I guess I measured something there, 22% drop. There was divergent high before COVID. As I've said repeatedly, COVID was not a random event. It'll go down in history as a black swan event, but a bear market or correction was priced in, and that's what we got. Technically, it was a bear market with a 36% drop in the S&P, although I only consider it a correction. I actually have a name for it. I call it Ursa Interruptus, because we were poised for a bear market, but the central banks and central governments around the world came in with just unprecedented, unfathomable fiscal and monetary stimulus. So they really steered it, prevented a much more prolonged bear market, and overstimulated the economy. So either way, it was there, it was real, and the divergences telegraphed it and played out as such. Then we put in a divergent high there, bigger correction, bullish falling wedge breakout. So here's where I'm going with this. These are all. Let me measure that one there. Yeah, I think that was the 20. No, that was a 37% drop. This one right here off that divergent high was a 39, right? And we got the thing about it. When you look at this, we got pretty far away from this primary. This is our primary trend line here. We're a lot in much closer proximity, number one, meaning that if we get a 25, 30, 40% drop, it's going to take us below that secular bull market uptrend line, triggering a more powerful sell signal. And in my opinion, bringing the discretionary sector back to ultimately, it'll zigzag along the way. It'll take a year or two to get there, but at 64, 50-ish level. And that's going to be a drop from the recent highs, and we're not far off those highs now, of about 44, 45%, which is in line with what I'm calling for the my ultimate downside targets on the stock market, on the S&P 500 and Nasdaq. Roughly 55% drops. And on that too, you have just these were normal bull market divergences spanning a few months. This is a multi-year divergent high right now, building. So it would project a much larger drop too. Okay, that's long-term stuff. We're not there yet. If and when that line goes, I will update you. Let's talk about today in shorter term. This is my daily chart. And again, you can see, in a bull, you put in these divergent highs, you have corrections. Divergent high, correction. That was a divergent low. They're not all marked, but you can see my divergence line. That's bullish. And along the way, divergent high, correction. Divergent high, correction. Divergent high 2, that's same divergence building, correction. Divergent high, big drop. Divergent low, bullish, rally. Divergent high, correction. So that's where we're at now. And we have a little small divergent high right here. If I zoom in nice and tight. So that was a high. And in the bull market, you keep making new highs. So far, this is a little bit, it's not the end of the world, but it's worth noting that so far, this high fell shy of the previous high. We're dancing on support right now, about 114. You can see these are some of the companies in here. I'm going to go through a few just real quick to kind of show you. Amazon, I don't see a lot in that chart that I like right now. Recently, I highlighted as a buy on the pullback to the 200-day moving average. It shot below it for one day, regained it the next day, and it's been a decent bounce, but that's all I think we're going to get out of it. Tesla's got a key uptrend line right here, so you want to watch this. And again, Tesla is one of the Mag 8, so that would have an impact on the market if and when broken. Home Depot. Somebody asked me about Home Depot yesterday. You can just go here. You can type in HD, hit enter. It was in the comment section. So the posts are going to be up top. Then you come down here and now you have comments, and there it is. So that'll load it up. And somebody asked about, Home Depot looks interesting, leaning on the bullish side. So my thing was, no. Here's my reply. I basically said, look, I was one of the most bullish sectors, in my opinion, just a few weeks ago, literally the day it bottomed, Home Depot. And I did extensive videos, and I did them all day, every day for the next couple days after that. Home Depot and all the home building stocks, highlighted ITB and XHB as long trades. And you can see it here covered if you want to see the link. But either way, that's where I highlighted it. And my reply was, we sheared the meat off, most of the meat or all the meat off that bone. And so it threw caution to the wind. And one thing about this site, you're not going to catch every trade. I'm not going to catch them all, but there's a lot of value in. Somebody just thanked me the other day because they were able to sidestep. They had a lot of gold mining stocks and precious metals. And before the crash, when we were at the highs, and I'll give you the sell signal, my targets that I covered earlier in this video, they were able to sidestep that huge give back. It wiped out a third or more, depending on what, gold mining stocks are in money. And they were starting to get eased back into them. And this was just a couple days ago. So remember, in trading and investing, just like in life, a penny saved is a penny earned. So it's not always about the big, the ones that you make profitable trades. It's just as important to avoid the big losses or the give back in profits, to have a trade that's up, 20, 30%, only to see all those gains and then some wiped out. On this one, I'll give you my 2 cents. That's the stock was it's already rallied 25% off that low. Again, we covered it right there, the exact low at support, bullish falling wedge. It went on to break out. But it's struggling with its 200-day moving averages. That was yesterday. And here it is today. So what I'm doing is showing you that, if anything else, and I think it was if you read through the comments, you wait for a pullback. You want to buy, but you don't buy a stock, as I said earlier in the video, at resistance. There's only two trades to be made when a stock rallies into resistance, especially when it's overbought. Trade number one is if you're long, sell it, take your profits, or bare minimum, tighten up your stops just in case it pops through there and continues to run, or you short it. So by that, the stock's already dropped 7%. See that? It hit the boom, boom, boom 4 days in a row, 4 days, consecutive days or trading sessions of testing that 200 simple. Couldn't get through it. It was overbought. PPO now is making a bearish crossover. The last time it made a bearish crossover was right here. And then the time before that was right here. What happened from there? This and this. So stands to reason there's probably more downside. So again, this is swing trading, guys. Get in, milk it, get out, move on to the next one. I'll rifle through a few more of this sector. McDonald's, big divergent high there. Bullish falling wedge, but it ran into the downtrend line. I'm not crazy about this trend line because it's not super well defined. If I had to take a guess, since I think the sector will probably go down, McDonald's may come down here. I'm going to lift this line up. It might be a buy if it can get down to about 262 there. It could run from here because you have positive divergence. Certainly a stock I wouldn't short. If anything, I'd wait for a pullback to that level. I'd look at the sector. I'd look at the stock market. I'd look, of course, at McDonald's and maybe try to game a bear market rally, maybe back to the 200s or something like that. So that one doesn't look so bad right now. Again, I wouldn't short it, but I'm not buying it either. Maybe if it gets down there, maybe not. TJ Maxx, ready to break. Look at this beautiful uptrend line off the May 2022 lows. And you get an added bonus with this 200-day moving averages. Look at this. Been riding the 200s like a world champ since it took them back right here, regained them after a bear market. That's the tail end of a bear market right there. Correction, at least 20, 30% drop. And this is what traders do on certain stocks. Man and machine alike, meaning humans and program trades, trading programs. They buy pullbacks to the 200s. So if you smash through that uptrend line, you're also going to take out the 200s. You got a little bear flag action going too. So if you get an impulsive drop down, you take the flag pull, the impulsive move down, measures right. Look at that. And I swear to you, I hadn't done this before. It never fails to amaze me when I take the measured target of a chart pattern, how well it lines up with the price targets I already have on my chart. So there's a support zone. In the bottom of that would probably be, if I wanted to, some people might draw the flagpole from that highest point there. I just took from where it really started falling impulsively. And that would be take you right down to the bottom of my target zone. So I'm going to write it in here just so if we revisit this one later. Target zone 7826. And maybe at one point we'll revisit that. And consider that a setup too, guys, if you're looking for trade ideas. Now, remember, only one of two trades to be made when a stock pulls back to support. You either go long, so if you're bullish, you can go long here and just go long with a stop somewhat below, or wait till the support level breaks, then short it. So it doesn't need much more. And you just want to see pretty much a break of the recent low should do the trick. And then set a stop, short it, set a stop right about here in case it whips back above there. And your risk reward's minimal. You'll make, if we hit that target zone, you'll make about 10%. All right, last one. Booking, positive divergence on booking.com, but it's coming off a big divergent high and a breakdown. See, here's the thing again: bull market riding up its 200s, put in a divergent high, broke trend line, back tested, got rejected, put in a little small divergent high, and now it's been bouncing long. We had a divergent low here. It gave us a bear market rally, but right back into the 200s. So as long as this stock remains below its 200-day moving averages, it's in a bear trend. It's probably going to zigzag lower. So this is the sector going low. I gave you Lowe's as well, one of the home builders that hit that first target. Starbucks, and one more. Let's do Dash. Let's go down to DoorDash. There's Marriott right there. DoorDash. I gave you DoorDash right here. I think I've got that one pulled up somewhere. Yeah, here it is. You can go back, reference the March 27th video. Just go back on the site to March 20th, or just at the end of the bottom of this post will be tagged with dash, DASH. Click on that. It'll bring you back to that. And so right there, I highlighted as objective long. It was just above support with positive divergence. I gave you a total of 3 targets in the video. And you can even go to that post. I added the AI summary and it'll click right on it. Here, so what I mean by that, if you go back to the 327 video, just ran it through there, and the DoorDash. So you just see some of these are hyperlinked. I like that when these AI summaries you just click, is going to pull you right to where coverage starts.
I did it for you a minute ago. Dash, DoorDash, DASH.
So there it is. So
for those of you looking for something long, DoorDash is coming up on a
and get back to and there's a weekly. I think I had paused the video and missed covering that. I just wanted to mention if I'm repeating what I just covered, my bad. But I just want to mention that DoorDash got rejected off the 200 moving average. It lost them right here, tried to regain them, and it remains in a downtrend. And so that's probably most likely the end of the run. And it just took out this trend line today. Again, I don't know where I pause the video. Sometimes I do that to collect my thoughts or move to the next chart. So hopefully the rest of the coverage of DoorDash was in there. But either way, that was it. So we highlighted here, right there, exactly at the low is a long entry, giving you 3 price targets, all of which were hit, and then we sidestepped to get back. That's what I was covering before. If it got skipped over in this video. Last but not least, QQQ. So this morning, before the market even opened, told you we had taken out in pre-market, took out that 705-ish support. Remember we had one last, so pretty weak hurrah off it yesterday, low bounce. The day is young. I still think we're going to close below it most likely. We have an intraday recovery. So the way to trade this, so this morning when I got the chart out to you in pre-market, we were back testing it. I said that was an objective short entry, or we're close to back testing it, as would be any push up on the NASDAQ 100 futures back to, I give you a range. This was the comparable level by 25 260 support. We lost it And if you go back, the previous chart was there I give you today. That was the next support level I had, and the next one and the next one where reactions likely. So I told you on NQ futures, here we'll tighten it up a little bit. And I maintain this that since we got that sell trigger, any pushback to that level or to this uptrend line just above would provide objective short entry. I'm going to move this trend line right now only because as I zoom in tight, I noticed that I should have it a little bit lower. And I'll tell you why here in a second. So let's try to move it. Gets a little hard on this particular program here. There, I got the end. That's how I fit it. Why? Because I'm coming in, I'm getting that reaction low, a little closer to that one there now, and I wanted to get in on that one there. So and I have price resistance. So this is still resistance on NQ, but short up to, but not above that level. You don't have to stop out immediately. Remember, our initial entry on this short trade's here, but I highlight multiple entries along the way, multiple objective levels to either book profits. Down here, that was when T1 was hit on QQQ, the first target. We had positive divergence on the Nasdaq 100 futures. We got a bounce and we put in a divergent high. Then you got a new sell signal there. Whether you covered the short here and you reversed long, or you sat tight, or with room to add, that was an objective one. But remember, at the end of the day, guys, we are going sideways right now, so there's a lot of noise within a trading range, a bigger trading range. Oh, that didn't work. Try to fix that again. Let's go here, 3-month hourly. Remember, this is your bigger picture. We're also in the holiday doldrums right now. That's I think I had it well, the top too. Had it shaded like that. There's one little brief pop below there, but this is really good support right here because I'm highlighting all the reactions that we've had off that level. So objective short here, but anything much above that, you might want to hold off. You don't, again, depending where your entry is, I don't think you need to stop out right away. There's a downtrend line as well, which makes it objective short. So this is my preferred scenario. We've already hit that next target / support at 28,940, and that opens the door. If and when today's lows are taken out, we should drop to my next support level, which is 28,525. Then down here, and remember, the official QQQ short trade has 4 targets, and that 4th target zone is pretty much a back test of, you got to go back to the daily chart, of the top of this multi-month trading range here. This coincides with T4. So, but this is the current trading range we're in. Need to take those recent lows. And if that happens, I put a high degree of confidence it will go down and hit my final targets. If something else happens, I'll address it at the time. As I've said repeatedly, the risk reward to me is skewed to the downside because I think there's a better chance of that happening. Come back, test the 200s. Than breaking out, because any new high anytime soon, I give you few guarantees in trading and investing and in my trade ideas or in my analysis, but I guarantee if it happens soon, as in this week or next, you're going to have negative divergence. But I can say that with confidence because the indicators are lagging that much that if we popped up real quick, you'd still have negative divergence. So we had a divergent high there, correction 1. We had a smaller, the divergent. This is just an extension if we get it. Remember, we had on the 60-minute chart, we had right here. A second, that was a little divergent high right here. These lines just disappear. It's just something this platform does. All right, that's it. So there was divergent high 1, breakdown, sell signal, kickback rally, put a second divergent high, followed by a sell signal. And that's it. A lot of messy, sloppy, sideways trading. Patience pays. And like any other trade, it's just one of many. So you're trading the indexes. Spread your bets with other things in there too. We've had probably as many, if not more, long ideas in the last few months, certainly hitting price targets recently. And so this video, I'm just highlighting some of the things that stood out today. All right, I'm going to wrap it up here, guys. Wanted to get to the regional banks and the semis. I'll just do that in the next video. This has been Randy Finney with Right Side of the Chart. Have a great day.